Well, good morning, everyone, and thank you for joining us for this morning's webinar, Is Your Marketing Plan Compatible for 2025? As a quick reminder, all attendees are muted and videos are shut off. However, we'd love for you to engage with our presenters today by using the chat feature found at the bottom of the screen. You can find that chat feature by clicking on the three dots if you are joining from a mobile device, or by selecting chat if you're joining from a computer. Before we begin, I'd like to introduce our experts on the call today, David Widmar and Dr. Brent Gloy, co-founders of Agricultural Economic Insights. We also have our very own Jeff Hoak, Senior Financial Officer here at Farm Credit Mid-America. As a reminder, this webinar is intended for informational purposes only and is not for public or media consumption. Any opinions expressed by the presenters are their own and do not necessarily reflect those of Farm Credit Mid-America. With that, thank you all so much for joining us today. As a reminder, this webinar is going to be recorded and distributed following today's presentation. And so with that, Dr. Gloy, I turn it over to you.
Thank you, Micah. It's wonderful to be here with everybody today, and I hope your spring planning is off to a good start, or if it's still a little too wet, it will be you'll be rolling here pretty soon. It's an exciting time of the year, and it's, I think, a good time for a variety of reasons to really think about your marketing plan for 2025, or to hopefully rethink your marketing plan a little bit for 2025 going forward. And what we want to do today is really look at kind of three themes in your marketing playbook. So as we start to think about 2025, the first question or theme that we want to understand is, what is the uncertainty that we're facing today? How big is it? We want to look at, kind of your cash flow situation. And the other thing that's probably a little different than in the past is trying to understand your carrying costs. So again, three kind of themes: how big or what is uncertainty, and how is maybe this year a little different than the last few years that we've experienced, or our recent experiences. We're going to examine cash flow, and we're going to look at carrying costs, which are might surprise some of us when we just look at some of that data. So to start off, when we think about uncertainty, I think it's a useful discussion. I told David when we were preparing for this that this is kind of giving me throwbacks to graduate school, of kind of this debate as to what's risk and what's uncertainty, and that's kind of an esoteric kind of debate. But in reality, there is a little bit of a difference, and I think it's appropriate here. And David has put on this slide a picture of a pool table set up with cue ball and the balls. And one of the really, he was just telling me this morning. One of the really fascinating things is, if you would think about this, you'd think, well, physicists ought to be able to model, when you hit the cue ball, it's going to hit the rack there somewhere, and the balls are going to go flying, right? And you would think that physics ought to be able to model, that break perfectly, because it's really just force and spin and all this other stuff. But what they have found is this is an exceedingly difficult problem to model, because there are so many variables in here, and so many things: the spin of the cue ball, the trajectory of the cue ball, the speed, how tightly the balls are racked, all of that other kind of stuff, that it's really a chaotic experience, and no two breaks are probably going to be exactly the same. So I think that's an apt discussion for today. There's lots of moving parts, and we're going to talk about that a little bit, because as an economist, we kind of like to go through, well, there's this factor and this factor and this factor, and this is, positive, negative, whatever, and this is what you should do. There's a lot of moving parts here, and that's where we're really talking about this kind of uncertainty, where the outcomes and their probabilities are very, very difficult, if not impossible, to predict, as to how wide a range of things we might experience in the coming year. And so let's just take an example of that and look at kind of visually what this means. And so if we have two distributions here, say the blue one is this is corn prices. In blue, we've got a range, and some probabilities. And then with greater uncertainty, what that does is it tends to spread out your outcomes and it puts more weight in the tails of the distributions or the highs and the lows outcomes of those distributions. And I think that's what we've got going on here today. And some of you might be saying, well, what do you mean highs? Everything is bad. And, we were just talking about this earlier. And so I think right now, as you think about all the news, and reflect on what you've been hearing, almost everything is negative right now. And so we tend to go to, well, it's just moving everything to the bottom side. That could be the case, but it's also possible that things could happen the other way as well. And we don't want to forget about that. So if we think about farm income in 2025, we can always we can always ask this question of kind of which narrative is going to win out. Okay, and this may seem surprising to you. So if you're really negative, you start to look at the slide on the left, and this is the U.S. ending crops stocks for 13 crops. And this is kind of a unique slide that David and I put together. This is David's idea, and I think it's a really good one, where kind of combines all of the crops and he converts it to acres of cropland because it's hard to combine an acre of wheat and a bushel of wheat and a bushel of corn. They're not really the same thing, but what we can look at is how many acres it requires to grow a bushel of wheat, how many bushels of corn come off an acre, and we can look at kind of what our ending stocks are in acreage levels. And what we see is that those acreage stocks have been increasing in the United States. So our ending stocks are up. They were fairly tight, but they're up and they're heading up. And when you add on top of um, the tariff situation where trade starts to become a little more difficult, you can see a situation where those Indian stocks are going to continue to climb in the United States again. Now, the other side of the story, so that side is pretty negative. The other side of the story is if you look at the world crop ending stocks, and again, use that acre equivalent number, what we see is a declining stocks to use ratio. So this number is kind of as tight as we have seen it in the last 20 years. So this is by no means is the world flush with crop ending stocks. The United States definitely is. And so we have to start to think about what that might mean for our marketing plan going forward. And we'll talk a little bit more about basis and those things later in the session. But something to think about, and again, something to say, it's not all a negative scenario. There's two sides to that coin. So if we go to the next slide, when we think about farm income in 2025, I think those famous economist words, other things equal or all else unchanged, the trade dispute is certainly a big headwind for commodity prices and farm incomes. Okay, I don't think any question about that. The last time we saw the trade war, we saw soybeans. We received market facilitation payments of about, I think it was $1.60. David will correct me. I want to say it was in the range of $1.70 a bushel. Maybe it was $1.50 or $1.45 a bushel on soybeans. And that was actually, I think, a pretty good estimate of what it took, because what happens in this trade dispute is commodities have to go places they don't necessarily want to go. What's different this time is that the trade dispute is broader than it was. More countries are involved than it was last time. So it's a little bit different, but it is definitely a headwind. Now, the thing I think we have to remember is that weather is still in play. And so, for instance, in 2019, we had a big preventive planting. we don't know what that's going to be this year. There's still that specter of possible prevent plant in 2025. There's also weather questions going into 2025. So we know supply in the US will matter. We just don't know exactly how that's going to play out. The other thing is that we've got a lot of macroeconomic factors shifting on a massive scale. You know, the US dollar is depreciated significantly against major currencies. That is really changing the picture. And we can make some trade deals, and there's also potential government payments out there. So there are a lot of moving parts, and it's hard to say other things equal because all these things can change. David, I'll turn it over to you
Yeah,
to
thanks,
talk a little
Brent.
bit about cash flow.
Thanks, Brent. Yeah, the second point here that we want to talk about is cash flow. And cash flow is, there's four major financial statements: the income statement, the balance sheets, the statement of cash flows, and the statement of owner's equity. And I think oftentimes in agriculture, we overlook this statement of cash flow. And I think it's probably a good time to back up and really dive deep into that. So we always encourage producers to know their costs of production, but knowing that cash flow is really about the timing and making sure that we know that we have enough cash coming into the business to meet all of our obligations, or that there's enough working capital in the business to meet all those obligations. And I'm reminded about one of our a friend of mine who always reminds me that necessity might be the mother of all invention, but cash flow necessity can kill every good plan, especially when it comes to marketing plans. So we don't want to get into a situation where cash flow challenges really force us to make suboptimal decisions. So one of the pieces I want to spend a few minutes or a few seconds here discussing is this what's involved in a cash flow statement. So this is something that I'd encourage you to think about how you're using it. Maybe you could build a budget for your operation, or maybe you could build follow that statement of cash flow. Sometimes these are built into our accounting packages already, but there's three main areas of cash flow that we want to keep an eye on. There's those sources that come from operating activities, such as our revenues and our expenses. We want to keep an eye on that investing activity. That's a major source of cash flow, but also there's the financing activities, such as maybe new debt that we take on, or those payments that we need to pull out. So what areas are really worth keeping an eye on when it comes to cash flows in 2025? Well, I think the first one here is that operating activities with respect to revenue. All of these government programs, these ad hoc payments, most of us are, getting close to receiving, if not already have received, those economic loss payments back from 2024. So that was a unanticipated increase in our cash flow. So we're going to keep a close eye on that. That could have an impact for our cash flow, a positive. When we have lean times in agriculture, sometimes that investing activity is where we pull back a little bit to help preserve cash flow. So maybe we're going to hold off on some capital purchase activities to help maintain that cash flow. And of course, when it comes to financing, maybe we're going to use maybe there's some restructuring. We want to make sure we get the right terms around our debt to make sure that those payments are manageable, or maybe we're thinking about expanding the use of our line of credit to help us meet all of those obligations. So these are things we intuitively think about or intuitively know about, but this statement of cash flow, and if we budget those cash flows, will give us a much better resolution as to how our business is utilizing cash and how we can make sure that we don't get ourselves into a tight situation. The next thing over here is, other factors that go into this cash flow piece of it. Beginning balances are really key. So if we start the year with a lot of working capital, I think it makes it a lot easier to make this all flow a little bit easier. Work cash flow tends to not be as big of a concern when we have a boom in the farm economy, when there's a lot of cash in our businesses, a lot of working capital on our balance sheets, but cash flow becomes much more important when those beginning balances, that working capital gets a little tighter, and all of a sudden we got to make sure that we're not going to run out of cash in this situation. The other issue here is the timing. This is where these budgets can be really careful. In agriculture, we put out a lot of cash this time of the year, and then we don't typically have a lot of those inflows until we get to the last maybe quarter of the calendar year, and we get in that tax planning cycle. So we really need to be careful with the timing of those inflows and those outflows, making sure we know where we are and where we stand. One of the questions that I really want you to think about with respect to your marketing plans, I challenge you to think about, is asking yourself two questions. What do you need to sell by harvest, and what do you need to sell by the beginning of the year? If you can set those goals based on those cash flow needs, maybe you know that you have some cash, the second half of your cash rents due later in the year, or maybe you know you have some payments, some debt payments that you need to make in the last quarter of the year. If you can start by really thinking about how much cash flow you need at harvest and how much cash flow you need by January 1st, that could really help you and set you up for success with your marketing plan. It's going to help you get a little more aggressive about making sure you get those bushels priced and get priced at a good price. What you want to avoid, going back to this quote at the top of the screen, is you want to avoid this situation where all of a sudden there's a maybe you forgot or you overlooked or you just fell through the cracks some way. You don't want to get into an environment where all of a sudden you have to market in a very tight window of time. So I'll give you an example. Maybe you realize on November 15th that you need to make sure you have enough cash flow to meet this debt payment in early December. So you have a couple weeks to market some grain, pull the trigger on that. But given all the uncertainty Brent talked about earlier, you would really hate to have to market your crop in a very narrow window with all the uncertainty and the chaos that we've seen in the tariff markets. And so make sure you have a lot of time to get those bushels priced, because we've seen these announcements about tariffs and reciprocal tariffs, and there's sort of a rumor, and then there's a threat, and then there's a really big number, and so far those have been backing up. So you just want to make sure you're not stuck into a situation where, again, that cash flow necessity is forcing you to market some bushels to meet a cash flow obligation in a very narrow window, which could be a unfavorable trade situation when it comes to tariffs. This third part here that we want to talk about today and challenge you to think about is the cost of carry. And this is often attributed to grain. It can apply to livestock as easily as well. But the idea here is, what does it cost you to store this commodity or hold this commodity another month? And for grain, I'm going to use that as an example. There's a few key buckets here that go in the cost of carry. There's your storage cost. There's that interest or that opportunity cost of putting those dollars into the bin. And then there's some logistics cost of actually storing the grain, handling the grain extra, and putting it into the bin, and maybe some extra trucking that goes into that. So you can think about those sort of two different types of costs there. Maybe one component of it's fixed, actually, augering the grain into the elevator, and then also the trucking that it takes to haul it out after you put it into the bin. So that could be a fixed component. It's going to happen for regardless of how much time the grain spends in the bin. And then there are variable costs, and so these are costs that are accrued on a daily or weekly or monthly basis, and that total varies based on how much time eclipses. So there's the storage cost. Maybe you're paying a commercial storage X bushels or X dollars per bushel per month, and then also maybe there's this interest or opportunity cost. Now there are some benefits of storage as well, so we don't want to overlook the benefits. Maybe you want to take advantage of some of the carry in the market, or maybe some of the basis appreciation that your area could experience, and maybe there's some harvest benefits, or maybe some efficiency gains that come with storing. So as you think about this decision to store or not store, these are always in the background. But what we want to focus on today is one of the elements that has changed quite a bit in the last few years, and that's this interest cost. And this assumption here is looking at commodity prices that we've seen over the last few months, but also prevailing interest rates. And those rates are above 7%. And so we put this in there, and so that's sort of this opportunity cost of either, selling the grain and applying that cost to maybe an operating load that you already have. But all of us have an opportunity cost in this situation. So your opportunity cost might be less than 7%. But the idea here is maybe your opportunity cost is foregone interest in a savings account. But the idea here is that all of us have opportunity costs, and that opportunity cost has gone up a lot in the last few months. Now you combine that or a few years, you combine that increased opportunity cost with current commodity prices. They're not nearly as high as we would like or hope them to be, but they're historically, above, say that 350 we were, about 10 years ago. So they're higher than they were 10 years ago. We have higher interest costs. So what's that look like? Well, for corn here, if we look at current conditions, the interest cost is about 3 cents per bushel per month. If you want to store grain from October, from that fall harvest, maybe into February, we're looking at about 5 months of storage, so that's about 14 cents. When I looked the other day, the difference between the December 25 and the March 26 corn futures contract was about 21 cents. So as you think through that storage costs and those returns to storage, 21 is that spread in the futures, and then 14 cents is the interest. So you have to start thinking, okay, what's the basis component, and also what's the efficiency gains I might be having. But the chart on the left shows that that blue bar, it's a really expensive time on an interest component for that corn storage. Looking at soybeans, it's a similar story in that it's historically high. Now it's about 7 cents a bushel. 5 months would be about 33 cents. But one of the key points I want you to think about and follow closely throughout the year is that spread isn't nearly as appealing for soybeans. So going from November to March, there was only about a 16-cent carry in the market. You compare that to that 33 cents of interest cost of storing that, you're going to have to assume a lot of basis appreciation, or a lot of efficiency in harvest, or maybe there's some speculative angle where you're thinking that the futures prices would rally. So just want to really recap that this interest environment when it comes to storing grain has changed quite a bit. So Brent, I'm going to hand it back over to you to recap this, and then we'll be back to chat with our lender expert.
Great. I'm just going to wrap it up really quickly and say, I think now is an excellent time to kind of review your marketing plan's starting point. We probably did those maybe last fall or early this winter. What's still relevant, and what expectations do we need to change or updated, and what initial assumptions need to be completely reworked? And I think for a lot of us, there's probably quite a few of those. And so it's a good time to kind of pull that pad out and look at it and see where we're at and what we need to change. I think the other thing we need to do is focus on strategies that kind of reduce our downside risk. Take that bottom outcome off the table, but keep some potential upside in place, because there are, as we talked about, a wide range of possible outcomes. You need to understand your cash flow needs and timing. So those are really, really important. And a marketing plan that's not consistent with those will get us into trouble. We don't want to be forced into, as David said, making cash flow decisions or marketing decisions based completely on cash flow at the last minute. And I think the other thing we want to watch is this grain storage costs and expected returns, especially with these basis levels changing rapidly as the United States starts to deal with, as we talked about, more ending stocks than we've had for a while. So with that, David, I'm going to just tip it over to you and talk with our lender expert.
Thank you, Brent. And it's my opportunity now and my pleasure to introduce Jeff, our lender expert for this month. So Jeff, thanks so much for working with us, preparing for today's event, and also joining us. I want to have us kick it off by you sharing just a little bit about yourself and your role with the association.
Yeah, my name is Jeff Hoak. I'm a senior financial officer, Washington Courthouse, Ohio, here in Southwest Ohio, Clinton County. I've been with Farm Credit going on 21 years now, and I came to Farm Credit 21 years ago from a agronomy background, so I sold seed, chemicals, and fertilizers for about 7 years before I came to Farm Credit. I'd also gone to Iowa State and got my master's degree in agronomy, so it was kind of in the agronomy end before I came here. Farm about 1,000 acres on a family farm with my dad, predominantly corn and soybeans, no livestock. I grew up with pigs. That's how I ended up getting a job after college, as we had pigs. So I ended up getting a job and finally came back to the family farm and have gotten to participate in that. So I've enjoyed being here. Appreciate you having me on.
Well, you have a rich history of experiences throughout the Corn Belt and the ag sector and different roles. So it's been great working with you, and I look forward to the questions I have for you, but then also all the questions that are going to come in from our audience. I want to start with maybe from the bottom and asking you, what's one of the bad marketing habits that you've observed as a lender you've seen that you wish that producers would avoid?
Well, I think the last few years before 2024 had spoiled a lot of us, and a lot of these bad habits are my bad habits too. So I'm not just picking on my customers, but the wait and hope it goes higher actually had worked out for a few years and worked out very well. So we've had a lot of customers that haven't forward contracted grain at profitable levels. And now we're in a situation where, things are stagnant or things are trending down. And that hope and pray strategy just isn't working like it did a couple years in a row. And all it takes is 1 year of hitting a home run, and it just totally ruins your marketing plan. I feel like happened to me personally too. So that's one thing that I've seen as a bad habit that's come up a lot. The other is not paying attention to cash flow. We've been planning in Southwest Ohio for about a week now, and I've got guys calling me that are, instead of planning, they're having to haul grain at cash levels, making cash sales because, hey, I've got farm payments coming up due to farm credit, so I've got to have trucks on the road instead of guys in the field. And I've got to get this grain hauled now, and I should be planting because I owe you guys a payment here on May 1st. So, couple bad habits. 4% interest on operating. It was pretty easy to, not pay attention to that interest cost. We're coming off a year last year where it was in the 8.5% range for a long time. When your interest cost doubles, you have to start paying attention to that as far as what you're budgeting for, how much you're borrowing, your cash flow needs as you spoke about. So there's got to be a lot more attention paid to those three things, I think.
Very good. What are some of the strategies that you've seen work successfully for producers?
The more successful producers that I work with, number one, they know their cost of production, at the first of the year. They know, probably what fertilizer is going to cost them either from fall application or prepay in December. You're starting to get your prepay numbers in December as well for seed and chemicals. So guys know what their cost of production is, what their debt payments are, and they've started to forward contract, to cover those costs, I guess, and instead of just waiting. They may have some price targets set. I'm going to sell some 450 corn. I'm going to sell some 470, at different percentage levels. That has worked very well for a lot of guys. And up until, 22 and 23, those guys that had marketed several years out had been, my higher producing net income customers. They've gone out more than 1 year. So, if they were able to capture that, if they went out and hedged some of these grain prices when prices were, higher a few years ago, they're definitely reaping the benefits now. So knowing their cost of production and then trying to go out and make incremental sales, just hitting singles instead of home runs. Those of us that are just trying to hit home runs every year, I feel like are starving, myself included. So.
As a lender and thinking about the marketing plan, what are some ways that a producer can get a higher ROI out of those conversations they have with you? What can they bring to the conversation around marketing that would make your job easier as a lender and help you provide more value for that operation?
Well, I know one of the things that we try to look at here at Farm Credit, every operation is different. So we do try to tailor those conversations to, the individual and what their situation is. I mean, if you come in here and you don't have any real estate or equipment debt, you don't owe us any operating, our marketing plan may be a lot different than somebody else's. So I'm 49 and have 4 kids under the age of 12, and I've got some real estate debt. My goals are a lot different than somebody that's, got kids out of the house that, maybe doesn't have a lot of debt. I'm trying, this year I'm kind of trying not to lose as much money as possible. So I'm trying to, cover my cost of production. And who knows what's going to happen with these tariffs, but I'm trying to leave a little bit of, the icing on top of the cake, for the end, maybe a certain percentage there in case things get crazy this summer where, I can capitalize on a little bit of, upside. But, right now, the cost to put out corn and soybeans right now isn't a whole lot different, than what it was last year. So I'm just trying to pay my bills at this point. So, when people come in and, we look at their family living, their financial position, what their goals are, we can kind of sit down if they know their cost of production. And, everybody's cost of production is different too, depending on what area you're in. I really need to see, what your cost is, not me guess at what mine is. Mine may be higher than what yours is or lower. So I need to see what kind of risk tolerance that you have, what your financial position is, and not just what your cost of production is, but, if I don't have all the facts and figures, I need to know what your bills are coming up, what your John Deere payments are, what, not just what your farm credit debts are. I need to know, when those payments are due so we can sit down and talk about that intelligently.
Well, Jeff, I think what I'm hearing, and David, is that to be a good marketer, you've got to be a great record keeper. And I think that's a pretty solid takeaway from today. Just a couple questions that I want to ask from customers that have come in. David, I want to start with you. I really appreciated the interest cost, and the customers did as well. The one question I had is, if I'm riding in a cab, how can I do that back of the envelope math to figure out what that number is for me? Because I think there was a lot of appreciation for that chart, but how do I maybe personalize that a little more?
Yeah, I think the back of the envelope calculation there is looking at the price that you would expect at harvest, and take that multiplied by your interest expense or your opportunity costs. And I think it's helpful to be consistent with how you're thinking about that, or especially over multiple years. And that would tell you sort of the cost of holding that grain for a whole year. So you can divide that by 12 to think about it on a monthly basis, or 52 to think about it on a weekly basis. But the idea is to say, how much is it costing me per unit of time? So again, per week or per month. And that gives you a starting point to start thinking about what kind of hurdle do I need to overcome. Now, if you're thinking about the other parts of cost of storage, which include, transportation or storage costs for the actual facility, you might need to do some looking around. Either if you don't have those records for yourself, look around. There's some university resources to help you think about, what's a good way of thinking about that, more than just the interest costs, sort of that total cost of storage.
Yeah, I think just to add to that, I think that interest cost is your basic hurdle, and those other costs, the facility and all that, you could figure that out too. But that interest cost is like your first hurdle, and so your expected gains have to be quite a bit larger than that to cover all those other costs. So it kind of gets you in the ballpark of whether it makes sense or not.
One thing I want to mention as we're having this conversation around record keeping is that year one records, if you feel like you're just getting started, are probably not going to be something that you're, willing to put your name on, and that's okay. Records get better every single year, right? So even if you're starting with university budgets, as David alluded to, year one, year two, you have the opportunity to maybe dig a little bit deeper into your own. So don't get discouraged with that. I think we're still early enough in the year where you can kind of get yourself on track. Another one that came in here was, sometimes we do get caught in that short window that you guys referenced, where you've got to make some financial decisions and sell some grain at inopportune times. Advice or tips on how do you navigate that?
Well, I think, the first thing is, say you're in that situation, you gotta get the best, make the best out of that outcome that you possibly can, and not just kind of throw your hands up in the air and get it done. And then I think the key thing is to make sure that, going forward, you don't do that again. So try and make the best out of that situation. I don't know, Jeff, if you have anything to add to that.
Well, I guess it really depends on, what you've had sold or what percentage is, sold. And that goes back to setting your goals and some realistic expectations where the market's going or could go. If you're comfortable with making a sale, if corn gets, 20 cents higher than what it is now, then, at the end of the day, you got to be the one that's comfortable with it. I would be right now.
Jeff, I think that leads us to our next question. When you are talking about those goals that you want people to kind of have figured out when they come to the office, what timeline is a 12-month goal, 5-year goal, 10-year goal? What's an ideal kind of timeline for you in your conversations?
Let me clarify, Micah, with grain sales or with just everything in general with your financial position?
Everything in general is financial position, yeah.
I think as much as things change anymore, I mean, we're constantly reevaluating these grain marketing plans, but it helps to know that 5 and 10-year goal. Do you have kids coming back into the operation, or are you, is your risk? Are you trying to build something for the next generation? Are you trying to save money to get them started? Do you have multiple kids? And I think you have to have a 5 and a 10-year goal anymore, and then reevaluate that marketing plan constantly.
David, I'd like to close us out with maybe just a little bit of a quick lightning round. It is difficult right now. Markets have created some anxiety. News has created even more so. I want to hear what you all think is the bright spot for production agriculture right now, or if you're still thinking about your marketing plan as you're in the cab of the tractor right now, what is the bright spot that y'all are still holding on to, if you will, in agriculture?
I'm surprised commodity prices didn't fall more. And so I think that there's been some resilience in those markets. I think another bright spot is I had a lot of concerns about trade struggles with Mexico, and it looks like those are trending in a favorable direction. Um, with agriculture, we want to have as many wins as possible, but we also don't want them all to be losses. And so there are some things going in the right direction, I think, are positive. If I could steal a third one, and I apologize to the rest of my guests, corn ending stocks keep working their way lower, and I think that's been an improvement. And so we'll see how that works through after all the trade and all of the production of 95 million acres works. But things have been sort of clicking along in that corn market in a favorable direction.
Yeah. So I would reiterate, the first thing that came to my mind is, I was like David. I'm surprised commodity markets been as resilient as they have, and I think that's a good sign. And when you look at that world ending stock situation, it gives us some hope, that things could improve. And I like I said, I think sometimes better, you hate to just tune out the world completely, but um, right now we're in information overload phase, and sometimes it's better to just take a step back and realize that the world isn't ending. And I have friends that get so worked up, and so much of I feel like they're so invested in things kind of beyond their control that they forget to step and look around and look at the situation. A lot of farms, good financial condition. We've had some good years. I think, we're going into this in a pretty good situation. So it will change.
Jeff.
I think the farmer's balance sheet looks a lot better than it did, 10, 15 years ago. So there's some strength in those financial statements to weather the storm. I'm surprised financials don't look worse than what they do after a year, looking at year-end balance sheets, just with the paper loss we took in 24 and then the, poor crop and grain prices that came with it. So, and farming's fun. So, I mean, you got to enjoy it. And I think there's going to be some opportunities, for everybody. So I'm pretty positive as far as that goes.
Well, thank you all. I really appreciate your all's perspective. As a reminder, this is going to be recorded and distributed following today's webinar. So thank you all so much for joining, and we look forward to seeing you the next time around. All right, everyone.